I met with a client the other day to go through a policy suggestion, a strategy suggestion. And I know a lot of people use AI to get things done for them, but sometimes I just use it to evaluate my work, if you will, just to see if what I'm doing is really up to par because you get comfortable in your own skin. And a lot of times you just start to do things out of habit and it's not always necessarily the best thing for the client. So I wanted to how the suggestion measured up so that I could just make sure and kind of govern myself accordingly. I got an A-, by the way. It was a B+, but then I clarified some things because it had misheard some things that I had said as far as age and the timeline, the time horizon. And then it upgraded it to an A-. I'm okay with an A-. It's a 3.8, I think, on the grading scale, but I digress. So wanted to take it one step further, and I turned around and asked it if another vehicle, I do infinite banking primarily, retirement solutions, annuities, trusts, all the things. And there's another vehicle that's being, it's an IUL. They're marketing it as infinite banking, becoming your own bank. And my stance wholeheartedly is that it just is not. It doesn't measure up. So I was just curious as to what it thought about that. And I'll come back later in another post and show you the grade and why I got the grade that I did because when was the last time you got to show off your report card? So I'm going to do it. In any case, I said, would an IUL have worked for this client? It said, no, an IUL would likely have been the weaker choice. And it comes down to the same three things that you argue in general, just applied to actual numbers. The first one is age and health work against IUL's cost structure because an IUL is underwritten like a term policy. Term underwriting is much more strict. It's actually easier, much easier to get than whole life. And we all know you get what you pay for. So if you're paying for term, which it actually is an annual renewable term, you get what you pay for. So that in itself tells you everything you need to know about the difference between the two vehicles in regards to infinite banking, becoming your own bank, as opposed to being your own bank, which is a whole nother conversation, becoming versus being. So the first one is age and health, work against the IUL's cost structure. She's 62 with high blood pressure. Her husband is diabetic with high blood pressure. IUL's cost of insurance is age rated and rises every year. Bet they never told you that. Deeply layered inside the policy. That's the worst possible cost curve to be signing up for at this stage of life, since the increase hits hardest in her 70s and 80s, exactly the year she's planning to lean on the policy for retirement income. Whole life's cost is level and guaranteed for the life of the policy. It does not compound that risk. So again, the rising cost of insurance, one of those levers that they don't typically talk about in the time horizon, how it can work against you. The second thing is her timeline is too short to ride out index variances. They talk about it as if it's going to return that same amount every year. It's tied to the S&P 500 or whatever you tie it to. And then they give this frivolous claim that this is what is done over the course of the year when they're measuring January 1st to December 31st. Your vehicle, today's July 20th, your vehicle is going from July 21st, if it got approved today, to July 20th of next year. Not the same, not the same window in regards to growth potential. But it says her timeline is too short to ride out the index variances. She's bridging a 2-year gap to 65, then possibly drawing $3K a month against the cash value a few years after that. IUL cash value depends on annual index crediting capped with the participation rate the carrier can adjust. They can change it whenever they feel like it. That's fine over a 20 to 30 year horizon. I still don't think it's okay because if you have access to the capital, then the thought is that you're going to steward the capital accordingly with other investments, other opportunities as they come up. So that's fine over a 20 to 30 year horizon where good and bad years average out. They never talk about the bad years and how it affects the IUL. They always speak of it as you can't lose due to market fluctuate, but you can because the cost fluctuates. And if you have a loan out, that works against you. But again, a whole nother set of posts where good and bad years average out. She doesn't have that runway. A couple of flat crediting years right before she needs to draw would leave an IUL short of illustration exactly when it matters. Whereas the whole life dividend has paid out every year for 120 years, regardless of market conditions. Now, that 100-year backdrop, that level of consistency, if we had that level of consistency in any other aspect of life, we would be tripping over ourselves. But we overlook it when it comes to our money. The third reason is the 30-day car payoff is the real tell. IUL cash value typically ramps up slowly in the early years due to surrender charges and acquisition costs that eat into it before it's genuinely liquid, which is why they tell you not to borrow from it from the first 5 to 7 years. Needing 22K accessible within 30 days of approval is a stress test that whole life, structured with the funding pattern you built, income plus savings plus half the retirement account, is specifically designed to pass. An IUL structured the same way would likely not have had that money usably accessible that fast. Absolutely would not. Not only that, but because of the rising cost of insurance and the interest rate on the loan pulling down on it, it would likely implode in the early years unless you paid it back, started paying it back right away, which you may not want to do. And you have that flexibility with True Infinite Banking. Then to sum it up, it says when IUL would have made sense, and I can still argue against this. If you want to put your IUL up against a comparable whole life policy, I'm more than happy to jump on a Zoom and do that live in a recording for you. You want to send it over, however you want to get it done. If she were 20 years younger and better health with a long accumulation horizon and no near-term liquidity need, the uncapped upside potential becomes a real argument. It becomes an argument. Depends on who you're talking to. None of that describes her situation. Given her age and health, the fact that she needs the money to work immediately, not eventually, whole life was structurally the correct call, not just the one you're more aligned with philosophically. So I say all that to say that there's a few things that differentiate the two: liquidity, consistency, and overall cost. Because like as I said, one has a consistent cost and one has a varying cost where it goes up every year. And as you get older, those gaps in insurance, those gaps in the cost of insurance get larger. And in the later years, you take bigger jumps in the cost of insurance. And if you're not taking bigger jumps or equal jumps in regards to the crediting, then that cost of insurance alone could become a problem, not to mention the loans pulling down on it. And then liquidity is an issue. Obviously, nobody wants to part with funds. If you are trying to change your financial situation, then you want to be able to leverage that capital to help facilitate that change. If you're already in a favorable financial situation, then you know what to do with the money to grow it already. So this is just a buffer, a cheat code, a means of duplicating the efforts of your money. Truly having your money be another income of your household without exposing it to any risk. So in summation, if we're talking about infinite banking, becoming your own bank, just stewarding your capital, there's really no comparison. It's not even a conversation. And I would sit down with anyone and line up your IUL policy structured the way that you say you should structure it: minimum death, maximum accumulation. So you're buying the minimum amount of insurance. But the fact of the matter is that's the ceiling. That's as good as it's ever going to be day one. And then everything after that it's just left to chance. Here, we're going to do basically the same thing, except you have more flexibility, more liquidity, and more consistency. And let's just be honest again, if we were more consistent and insert any aspect of our life, we would be better off. And your money is no different. So DM Bank, DM me. You can reach out to me directly, email, however you're accessing this information. If you want more of it, just let me know. If you want to talk about your specific situation, if you got an IUL in the last 5, 10 years and you want to look at, it's never too late. And just like if you're driving down the highway, you don't wait until you get to your destination to look back and see if you went the right way. The second you realize that you might be going in the wrong direction, you get off and check the map. Or now we have GPS that adjusts on the fly. So your GPS adjusts accordingly. All I'm telling you to do is look down at your GPS, make sure it's still taking you where you want to go based on the information that you have access to now, and then evaluate the situation from there. I hope that helps. I hope if any of this needs clarifying or goes over your head, just let me know and we can have a more in-depth conversation, because I speak English too, not just this stuff. Have a great day.